Okay, jumping right into it. So after this video, you'll understand exactly what trading is and what types of markets you can trade on. Um, you'll understand prices, how they move, how to read them, how to understand a chart. Um, yeah, it'll light a lot of the darkness for you if you've never traded before. So let's get right into it. What types of markets are tradable? I have the main four ones listed here. So a lot of us have heard of the stock market, and this is just the buying and selling of portions or percentages, also called shares, of any company. So there's obviously many hundreds of companies listed on the New York Stock Exchange. Different countries have their own stock exchanges. The next one I have listed is cryptocurrency. So the cryptocurrency market is the buying and selling of digital assets. So most people have heard of Bitcoin. That's the best example. It's a digital currency. The next one we have are the commodities, or is the commodities market, and this is the buying, selling, trading of any raw material or agricultural products. So coffee is a commodity, gold, silver, rice, oil. Lastly, we have listed is the forex market, and this is a market consisting of the trading, buying, selling of one country's currency for another, or in the case of the euro, where it's a union, so that currency for another. So most of what I teach will be how to be profitable in the forex market. I also trade commodities like gold and silver. So the patterns though can be used in any market. I have traded a lot of cryptocurrency with these patterns and messed with a little bit of the stock market as well. So moving on, how do we make money in these markets? So as traders, we profit by accurately positioning ourselves in a market before it moves. So if we expect it to go up, we're going to buy or long before it goes up. And if we expect the market to go down, we're going to sell or short the market before it goes down. I find this is one of the best quotes about all markets that I've ever seen. Warren Buffett says that the stock market is a device for transferring money from impatient to the patient. So um, like I said, this applies to all markets, and patience is so important when it comes to trading successfully. Why do prices move? So the main three reasons are first, news or events, and in this case, a good example is when coronavirus started to become an issue, especially in the U.S. The New York Stock Exchange tanked by a lot. And then shortly after, when there was a stimulus check announced, the stock market went right back up because a bunch of people got this money to invest into random things. So those were two great examples of news and events that caused a big movement in the market. Next are fundamentals. So let's say, for instance, gold or silver are things that you're trading. And when that stimulus came out here in 2020, a lot of inflation was added to the market or to the dollar. So because of that, naturally commodities will go up because our US dollar is backed by things like gold or silver. So naturally, when the value of the dollar went down due to inflation, the value of gold and silver went up. Pretty cool. And then lastly is speculation. So speculation is mostly in cryptocurrency and stock market. It's just that people think that something is going to go up, and when enough people think that something is going to go up or down, then they put their money behind it, and it causes the market to move. So all these really are just different examples or different reasons to explain different levels of supply and demand. So if you have ever had any economics or business class in high school or college or otherwise, you've heard of supply and demand. And if you haven't, supply and demand is just the measurement or the amount of a commodity, product, or service available, and then the desire of buyers for it. So this is honestly the main factor regulating prices of anything. So basically, supply is the more that you have of something, the less valuable it is. So, for instance, I just mentioned the US dollar. The more US dollars there are, the less value of each dollar. When there's high supply of something, it means people are selling it and the price will go down. Next, demand is the lesser the availability of something is, the higher its value. So when there's high demand for something, it means people are buying and the price will go up. The less there is of something, the higher it goes, right? Moving on. So really changes of supply versus demand are represented by a change in price. So this is where we get into reading charts and understanding the movements. And if you can understand, of course, what you're reading when you're looking at a chart, you're going to better be able to predict what happens next. So, how do we understand price? So, price is measured, or we're able to read it by watching candlesticks. They're a lot more simple than most people think. They're called candlesticks because clearly this looks like a candle body, whereas these look like wicks. So the difference in these two, the red and the green, one is bullish, means it's going up or it's increasing. The other is bearish, meaning that it's decreasing or going down. So this is labeled pretty clearly, but the bottom of the body on a bearish or an increasing candle is the open or the beginning price, okay? And then the top of the body is the close or the ending price. And each candle is measured in a time period. So here in a moment, I'm going to switch to a live chart to show you exactly what I mean in a live example. But let's say that these candles are on a 1 hour time period. That means that this price movement happened over the course of an hour. So this is the start of the hour. This is the end of the hour. And these wicks mean that in between the start and the end of the hour, the price moved all the way down to here and all the way up to here. So the close of the current candle or the close of one candle lines up with the open of the following candle, always. So in this case, since this candle went down, the close lines up with the open, and the close of this candle, the end of this hour period, was at the bottom of the body. Adversely, if it had gone up, then the close would be at the top, but just since it went down, the bottom is the close. And in that 1 hour period, the price moved all the way down to here and all the way up to here. But it started at the top of this body and ended at the bottom. Okay, I'm going to go to a live chart to make this way more clear for you, okay? And I have a hack, a life hack, a trading hack. You can see that my candlesticks are black and white. And the reason behind that is because as humans, we have a subconscious bias with the colors red and green. So the first instance is of stoplights. Another instance is if we were ever watching the news when we were kids, they had the stock prices flashing red and green. This to me, I like to have no bias, no emotional attached to when I'm trading. So the black and white candles help me to just see pure logically instead of having my subconscious bias attached. Okay, just a side note. So how do we read a chart and understand it? So on the bottom here, you can see that we have the dates. Okay, so this was the beginning of June, June 8th, June 15th, June 22nd, right? So on the right side here, we have the price. And you can see here that this is priced in US dollar, right? So that means that this is $1.27.5 right there, okay? So looking at the candles, this is a time period setting of a daily candle, right? So that means that each of these candles is a 1 day time period. Right? So on the bottom, we can see this specific one was June 30th, 2020. The next one, July 1st, July 2nd, 2020, right? Remember on the candlestick, the other chart I was just showing was showing two perfect candlesticks. So you can see that they're all different here. So this is a bullish candle. Actually, let's come to this one. They're both bullish candles because they went up, right? The beginning of the candle price, the beginning of this day is at the bottom of the candle, while the end of it is at the top of the candle body. So let me go back to the pointer here so you can see the wicks. So you can see though, in the course of this day of July 1st, the price started here and it ended here, but during the day went all the way down here and all the way up here. Okay? So now the following candle, you can see it's a lot smaller, but the close of this one will line up with the open of this one. So we'll have to zoom in a little bit to see it better. Okay, and so we can see that it opened up here and it closed down here because the close always lines up with the open of the next candle, which was right down here. And during this day, it moved all the way down here and then up just a little bit above the close right there, but it closed here. Okay, and then back to this candle, you can see that they pushed the price up here during that day, but it ended up coming all the way back down. So candles are pretty easy when you get to understand them, and when we get to patterns, you can see how there can be some patterns in looking for these candle bodies and these wick sizes. Perfect. So let's bring it back. The next thing that's really important to understand are pips. So you can see when we were looking at the price, it had a lot of decimals for each price. So here we have, let's say this is $1. We have $1 and 24 cents, and then this is a tenth of a cent, a hundredth of a cent, a thousandth of a cent. Okay, the hundredth of a cent, or if it was the pound or the euro, the hundredth position is 1 pip. That means that this is 0.1 pips. So a pip is what we will use to calculate our gains and our losses, and when we set a goal to trade each day. So if we're looking for the price to go up, we'll set a goal of, I want to make 10 pips on this trade, or 50 pips. So this position would have to go up 50 more than what it is. So let's go to a live chart again. Okay, this price, we can see the pips are represented here. You know, here's our buy button and our sell button. And let me move the window over so you can see a little more. Right here, we have the price listed. That this means that currently we're trading the British pound versus the US dollar, and it would take you $1 and 33 cents and 2/10 of a cent and 2/100ths of a cent and 1/1000th of a cent to buy 1 British pound. Okay, pretty easy when you lay it out like that. And a lot of the things that we use to chart, this will be your tenth of a pip. So let me come back. See, we got the tenth. It's always a smaller number, which is awesome. Makes it easy for us. So that means this is 1 pip. Pretty simple. Okay, coming back. Lastly, in Forex, it's important to understand spread. Okay, so what is spread? So let's say that I want to buy this really, really nice water bottle you have, and you're selling this water bottle for $101.20. You're asking for $101.20 for this super nice water bottle. It lights up, it's super cool. And I think that because I've seen other water bottles on the market, that it's only worth $101.15. So there's a bit of a spread between the price that we agree on. And the spread between the price that we agree on is 5 cents. Okay, so let's apply this to an actual chart. Let me drag this back over so you can see the full thing. So right here, we have the sell button and we have the buy button. Okay, this is telling us, it's counting in pips, that this is saying that there's a 0.4 pip spread. So this isn't even 1 pip. This means that the tenth of a pip position, there's 5 of these and 1/2 of these. You see how it keeps moving? So spread constantly moves based on the ask or bid price of a currency, and it's different for each currency. So pips and spread tend to be things that most people get caught up on. As you trade, you will get to understand them a lot better. And if you need to rewatch this video 5, 10 times, that's totally cool. Cool. So after this, you should totally understand how to read a chart. If you ever have any questions, feel free to reach out. I wish you nothing but blessings on your trading journey, and we'll see you in the next video.